Hey guys, it's Will. I wanted to talk to you about investing today with dividends. Saving your money is a good thing. You want to put some money away every year. And over the years, I've invested in a lot of different things, from mutual funds to um, you know penny stocks like mining stocks, and just maybe a hot technology stock like Apple. And the common wisdom is basically that you buy a stock at a certain price, and then you hope in the future that you can sell it at a higher price. And people are looking for hot stock tips, and there's not many people that really study and analyze a stock and try to figure out what it's worth. And there's just so much emotion and complexity around it. So I tend to like to simplify things. And after years of trying different things, mutual funds, you have management fees, you have load funds, like where they charge you at the beginning, no loads. You get charged on the back end. Um, all these hidden fees can chew into the returns you get, and also the uh, the people that have the managers are trying to time the market, so they're thinking, well, it's going to go down or it's going to go up, so they buy and sell, and they keep some of that money in cash, so it's not actually invested. And just over time, I just never felt like I was getting anywhere. And then I read a book called Stop Working by Derek Foster, and he talked about how he retired pretty early, and one of his main ways was through the purchasing of dividend stocks. So I'm going to explain what the dividends are. So basically, you have these companies out there, and they earn a profit, and they can keep the money, and they can reinvest it in their own business, or they can give it give it to the shareholders as dividends. So this is like after-tax revenue. They've got this money sitting there, and they can give it back to the investors. And I really like that, because when you hold a stock every quarter, generally speaking, you're going to get a payment. And the other thing that highly reduces any kind of risk, a lot of people are afraid of stocks. What I'm talking about is buying very mature stocks. They call them, a lot of times they'll call them blue chip and stuff like that. And what you want to do is look at stocks that have a history of increasing dividends. So this means it's not just a short, a recent thing where they started paying dividends, or dividend goes up and down. What you want to see is for the last 10, 20 years or more, that they've continually increased their dividend. So these stocks are often held by pension funds and things like that. If they ever decided to drop their dividend, they would just get, killed. Everybody would sell off their shares. So these are long term. The other thing to note is that these companies tend to be very secure in good times and bad. So this would be like items that you need to buy no matter what happens in the economy, like toothpaste. Banks, they tend to do really well. Energy companies like pipelines, gas, and like that. The other thing you need to do is look at your own personal ethics. For example, if you don't approve of cigarette smoking, there's certain companies that you won't necessarily buy. So, you can look at each company. I try to buy stocks that generally I understand, like consumer goods, things that people need to buy. No matter what happens, there's always people buying things for their home. Like I mentioned. So that's the gist of it. I feel like when you decide you're going to buy stocks that pay dividends, it so simplifies everything. You don't have to worry about timing the market. You don't have to worry about you don't have to get into the details of the company and the management. And these are not buy and sell quickly trading type of things. These are generally buy and hold for long term. So you get the benefit of the dividend payments, and you also get the potential gains of the stock over time. So I'm going to just show you a quick example of how I would go about buying a stock, and looking at the company as well. Now, if you decide you want to buy a stock, the best way to go, in my opinion, is to use a discount broker. So this would be, a lot of the banks have a discount brokerage. So in my case, being in Canada, there's this TD, Toronto Dominion, and there's a web broker, and you can buy stocks and other things online. So you want to set up an account, a discount broker account, and it's generally free. And you also have to look at if you want what kind of an account you want this to be. So I've got a few different accounts. In Canada we have an RRSP. It's like a savings account for getting like a tax reduced savings account. So when I invest in this RSP, I get a tax return. For if you're an employee and you're getting taxed, and you contribute to your RSP, you'll get a tax return, a refund at the end of the year. And then we also have this thing called a tax-free savings account, where when you put the money in there, you don't get a tax return, a tax refund, but in the future, when you take the money out, it's tax-free. And I know in the States, you guys have similar types of accounts, and other countries, you guys can figure that out. In my case, also I want to mention that this account here is actually in my business. So these two are in my personal account, and this one is in my business account. So I have a corporation. When I make money from the corporation, I can invest it within the corporation, so I don't have to take it out of the company, invest it personally. Because if I took it out of the company, I would get taxed on it in my personal possession, and then I could invest it through my RSP or TFSA. But I'm leaving it in the business so that it stays there. But that's you can do this in any account that you have. So you have to set up an account with one of your discount brokers in your local area, and most of them now have a web-based interface so that you can do this. So what you can do is think about you can look up some stocks that have a history of increasing dividends. I'm going to give you an example here, but I'll show you how you can find some of those. So we're going to look at Colgate, CL, and that's on the US market. So in Canada, I've got the ability to buy US and Canadian stocks. I'm actually going to go to the markets and research section. So depending on which web broker you have, there'll be different ways of doing this, where you want to look at the companies before you invest in them. So I'm going to put in CL, Colgate, Palmolive, and here's the stock price. But what you want to do is go to the I'm going to click on charts here, and we're going to see a chart of Colgate, and this is every year since like 1982 or so. And when you hover your mouse over, you see you can see the dividend. Well, 3 cents, 4, 5, 6, 7. You can't tell that they're going up because it's following the graph of the pricing. But if you go down a little bit here, you'll see the dividend that goes up like this continuously. So that's one thing you want to check. So that shows that this has had an increasing dividend 38, even though it's this is the graph of the stock price. You can see down here that the dividend has continually gone up. So that's something you want to check. And go back to order entry again, and I'm going to say buy, and I'm going to put in 100 just for fun, and I'm going to say CL, which is the symbol. Get the quote just so get the price. So right here you can see my cash is $44.53. I've got all my money actually invested in stocks. So there's only no cash available right now. I just bought some stocks actually. So sometimes the cash will build up in your account because you're getting paid dividends, and then at some point you can buy more. So anyways, I'm going to buy 100. Let's say I'm going to buy 100 of Colgate. And then it says price. Generally, I keep it at market price, so that means I'm just going to buy it at whatever the market is. So this is the bid. So people are bidding 61.29. That's what they want to pay, and the ask is 61.30, and the last trade was at 61.30. So this guy he wanted to sell it at 61.30, and so when you go to buy it, if you say market, they'll just buy it at the current price. Some of you guys might have options to limit it. So if you put market, you don't want to, if you're bidding on a stock, you don't want to pay anything. There might be a certain limit, and then it says good for the day or good till a certain period of time. So if you don't get it by the end of the day, it'll just expire. But if you wanted to keep trying, you could put a future date, and then all or none. So when you buy stocks, depending on the amount, you might say all or none. So you want to buy the whole amount at one shot. You don't want to buy, you don't want to do it in multiple transactions because you pay a transaction fee if you do it in multiple batches. So if you wanted to buy 1,000, or like in my case, 100 shares, I don't want it to be 50 and 50 shares twice. I want it to be, I could say all or none. If I can't sell 100, I don't want to do it. Okay? And then when you go to the next, when you go next, you might get some. I'm not going to do that because I don't have enough money in here for this purchase. But when you go to the next step, in my case, it'll give you some warnings. For example, if you're buying something in a foreign currency, it'll say that there has to be an exchange, and if you're buying more shares than are currently available, it could result in price volatility, which means that you might pay more than the current price because there's not enough shares available for what you want to buy. So it's really simple. You see how much you have in your account. If you want to buy the whole amount in one stock, you would put in the amount, and you can do like what I do is I go to Google. If the price, little calculator here, 61.30 times 100. And so, that's obviously 61.30. But so if you have a certain amount in the bank, say you had $5,000 and you wanted to know how many shares can I buy, you divide it by 61.30 and you get 81.5. And the thing is, you have to consider that you also have to pay a transaction fee. In my case, there's a $10 transaction fee. So if you think about that, that's really low. If you're buying, thousands of shares of a stock, and you're only paying $10 fee, it's amazing compared to all the fees that you normally pay. And there's only a one-time fee, whereas the mutual funds, you got management fees every year, potentially other fees. So this gives you a rough idea how many shares that you should buy based on, if you had 5,000, how much the stock price is. If you want to actually find stocks to buy, you could do something like stocks with history of increasing dividends. There's a few other ways I'll show you in a second. "25-year dividend increasing stocks." So that's a really long period of time. So here's the Colgate I told you about. Colgate, Johnson & Johnson, the shampoo, stuff like that. Procter & Gamble. And some of these, you might have personal issues with. You have to look at each one and see what they sell and what they're all about, depending on your ethics, whatever your concerns might be. 3M, that's the tape, the all sorts of. Lowe's, that's a hardware store. So it's an easy way to get some ideas. If I say Dividend Stocks Canada, so here's some. Emera, that's like an energy. Bank of Nova Scotia, Royal Bank. So you get your banks. There's some real estate stuff in there. So that's there's not much in that particular one, but it's definitely going to be, you definitely want to check out some banks. So hopefully that'll help you. And when you buy these, you could always call the discount broker and talk to them. And you actually you want to talk to them and see if the stock has a DRIP, which is a dividend reinvestment plan. So when you buy shares in that company and you get paid a dividend, the money will sit in your account and build up. And what you want to have that happen is you want that money to be reinvested automatically, and that means that they'll buy more shares, so you don't have this buildup of cash in your account. But not all the stocks have a dividend reinvestment plan, and so it's just on a one by one basis. Hopefully that helps you guys. I think dividend stocks have been amazing. I don't worry about the ups and downs of the markets anymore. It's generally a buy and hold. Mature stocks that aren't going to go crazy. It's not a greed factor, short-term thing. You're just holding. These are companies you understand, like retail companies, Lowe's, Canadian Tire, banks, and lots of consumer goods, and just everyday things that people are going to use no matter what happens with the economy. So it's not a get-rich-quick scheme or anything like that, but it's really worked well. So and you should try to save your money no matter what situation you're in. Put a little bit away, every month, and sort of take it off your paycheck if you can. But avoid all the as much as you can, unless there's like a work thing where they'll match your payments. You want to take advantage of any of that type of thing where your work is going to match what you put in. But other than that, you want to be in control, and I think dividend stocks are an incredible way to go. Hope that helps you guys. Talk to you later.